Okay, so then into the next step, which is if we have identified a financial asset, what should we do with it? So there's going to be really three major buckets when we deal with financial assets and how we classify them, okay? And maybe it's easier to work down as opposed to work from top down rather than let's work from the bottom and let's work up. When we classify a financial asset using amortized cost, the idea here is that the entity holds the financial asset, right? The entity holds the financial asset until its maturity. The financial asset is largely going to be based on contractual cash flows. Okay, there's going to be contractual cash flows for this asset. And these cash flows themselves relate specifically to interest and principal payments. Okay, so you can see what kind of examples give rise to amortized cost method, right? So things like a trade receivable, things like a loan receivable, things like, so loans pretty much, right? Or debt instruments. Because when the company, so if you are a company and you make a loan, right? So I'm a bank, say I represent CBA. I give people loans, right? That is an asset for me, right? This is a loan that I know I'm going to hold on my balance sheet until the person who I've loaned it to, until the borrower repays all of the interest and the principal back to me. Right? So when we have financial assets of that nature, we classify this as amortized cost. Now let's go to this other spectrum here, which is fair value through profit and loss. Now, under the fair value and profit and loss approach, the financial asset, we primarily hold these financial assets for trading, in the sense that we buy in, we buy out, right? We buy in, we buy out. And so when we have that sort of characteristic, they are held for trading. We classify this as fair value through profit and loss. So if I represent BlackRock, okay, so BlackRock is the world's biggest fund manager. I will buy shares and I'll sell shares on a daily basis, on an hourly basis, on a minute by minute basis. I would need to classify this as fair value through P&L. Okay, I'm buying these securities and I'm holding it for trading. And then we arrive at this fair value through other comprehensive income, which is really going to be the classification approach when it doesn't fit the fair value through P&L and it doesn't fit through amortized cost either. Okay, and so they are going to be the three major ways that we're going to be classifying financial assets. So here you can see that as part of this diagram, we look at this test here. So if we look at, we'll go through this diagram in a bit more detail, we can see that a company can choose at initial designation whether or not it wants to classify the financial asset as fair value through P&L. Okay, so companies can just say, look, let's put this as fair value through P&L to eliminate an accounting mismatch, and then it goes here. The second test looks at contractual cash flow characteristics. And so are the cash flows from the asset primarily related to principal and interest? Okay, so this is what this is. This is what this test is, okay? And if the answer is yes, then it pretty much puts you down the line that you're going to classify this as amortized cost. Okay, so this is the first test. Are the cash flows primarily related to payments of interest and principal? So these are going to be some examples, okay, where we've got bank bills. Okay, so bank bills are when you deposit money, you buy a bank accepted bill in the short-term money market, and it pays you interest, right? And it pays you the principal as well. So clearly the cash flows for a bank bill is both principal and interest, and therefore it satisfies the SPPI test. When you put money with a bank, what do you get? You get interest and you get your principal back. Okay, so that clearly satisfies the test. When you buy a government bond, okay, so you can buy bonds on the that's issued by the Australian government or the New Zealand government. So when you buy a government bond, what do the bonds give you? The bonds give you interest and they give you your principal back. So again, they fall under this SPPI test. So are the cash flows from the asset primarily related to interest or principal repayments? If we buy a share on the ASX, what do we get from shares? Well, we could get dividends, but dividends are not contractual. Will we get our money back when we buy shares? The answer is probably no. So that does not meet the SPPI test. If we buy a convertible bond, so this is a bond that after a fixed period is converted into the number of shares, okay, then what you will find in this case is that they will also be not classified as being SPPI, because once it converts into shares, then you're not really going to get your principal back, right? An interest rate swap, okay, is a derivative instrument, and that also does not satisfy the SPPI test. So the second test here, which is going to be in here, is whether or not the company intends to hold the asset, to hold the financial asset until it is due, or until it hits its maturity date. And so it's about applying this business model for managing assets. So specifically, if the business model is here to hold and collect contract cash flows, then the classification is going to be amortized cost. If the asset, if the business model is to sell financial assets, then it's going to be classified as fair value through P&L. And if it sort of does a bit of both, then it's classified as fair value through OCI. Okay. So what you really need to get out of this, okay, is this idea that if it's fair value through P&L, the entity trades this on a constant basis. It's held for trading. If it is classified as amortized cost, then the company is here to collect cash flows, and that these cash flows are predominantly made of principal and interest repayments. And if it's somewhere in between, it's going to be fair value through OCI. Okay, that is going to be the key logic behind how you classify financial assets. Okay, so again, there's going to be this initial election that gives an entity the ability to recognize fair value of in investment across OCI, so fair value through OCI election. Again, what is held for trading? Held for trading is when assets are acquired for the purpose of resale. If we were to receive any dividends on a financial asset, okay, regardless of where that is being recognized, that will always go into P&L. Okay, and we also have this fair value through P&L election, okay, which means that at initial recognition, the company may just designate this as fair value through P&L. Okay, so you can see that companies have these elections, which is to say that they have the right to classify this in a mechanism that they think is most suitable for their purposes, or you just follow the standard classification. And what about financial liabilities? Okay, so financial liabilities